Headline CPI came in at 3.2% on Wednesday, slightly higher than anticipated and 0.1% higher than last month's reading of 3.1%. So why is it that risk assets like stocks are rallying and gold is falling? Shouldn't the markets be looking at this and thinking to themselves, well, the Fed may postpone rate cuts because inflation is still hot? And in fact, the CME Fed Watch tool is pricing in a pretty much a 0% chance of a cut by the next meeting in March 20th, and a very small percentage chance of a cut by May. So why are markets reacting the way they are? Let's find out with our next guest, Peter Krauth, who's also going to give his prediction on not just the economy, but also silver. Peter is the author of the Silver Stock Investor newsletter, very popular newsletter, and the author of the best-selling book, The Great Silver Bull, Crush Inflation and Profit as the Dollar Dies. Before we hear from Peter and his thoughts and his outlook, a shout out from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the IRA space for cryptos. It also has unique tax benefits. So if you're over 18 and you like to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to learn more. With Bitcoin rising to new all-time highs and perhaps surpassing that again, now might be a good time to look into IRAs to park your Bitcoin profits. Peter, welcome to the show. Good to see you.
Same here. Thanks very much, David. Thanks for having me.
Let's talk first about what's going on right now in the markets, the economy. The CPI report came out today on Wednesday. So the consumer price index rose by 0.4% in February and 3.2% from a year ago. Now, the previous month, the headline CPI rose only 3.1% in January. So it's getting not significantly hotter, but just a little bit. It's just staying on course above 3%, which is still nowhere near the Fed's 2% target. Remember, the Fed wants inflation to come down closer to 2% before they take action, right? So how do you think this affects, first of all, their outlook, and then we'll talk about market reaction?
Yeah, so not that long ago, the Fed was talking about, or I should say the market was sort of pricing in as many as 6 cuts and starting as early as March. I always felt that was too early. My sort of working scenario was that it wouldn't happen until at least mid-year. So there are more CPI prints to come before we get closer to that sort of time frame. But I think that it is more likely when these rate cuts happen, I think mid-year to even after the middle of the year, slightly after the middle of the year, is the more likely scenario. At 3.2%, we're still almost 50% above the Fed's target, and I think that this is looking out perhaps a few years, maybe a couple of years. I think ultimately, not just the Fed, but other central banks are going to have to rationalize and come to grips with what's happening with inflation. And they're going to, I'm gonna say they're going to raise their target from 2%, arbitrary 2%, to a more realistic 3% as a long-term target. And I think we're in an inflation decade. I don't think that's going to change. And I think we're going to see a repeat of the 1970s, where we had multiple phases of rallies in the inflation rate. The Fed steps in, raises rates, inflation backs off, and then that cools things for a while, and then it flares up again. And I think we're going to see that happen this time around as well.
So here's what I would like clarification on, Peter. Me and perhaps some of the traders and investors. The median forecast for the CPI was 3.1%, 3.2%. The actual number came in hotter than expected. Now, if it's hotter than expected, wouldn't you expect the Fed to, taper back their rate cut expectations? But that's not what the markets are, pricing in this morning. The S&P 500 is up a lot, 0.86%. As we speak, the NASDAQ is up more than 1%. Gold took a huge dive, down 1%. Dollars up, treasury yields are up. Why do you think markets are reacting as if the Fed is going to cut ASAP?
The market isn't, first of all, the market's not always right. And we've seen that, not efficient. Multiple highly successful investors will tell you that the market certainly is not efficient. I just think that the market's getting ahead of itself. And like I say, more than likely, when the rate cuts come, it's going to be in the second half I think odds are pretty good in Q3, for example. The market's probably just kind of hopeful. You know, it's getting ahead of itself. I think that a lot of the stocks are very much beyond rich valuations. It's getting very frothy, and I think that we talked before about risks of black swan. Well, a crash or a short-term crash on the order of maybe 20 to 30%, in my view at least, is something that that investors in the broad markets need to be prepared for.
20 and 30% crash in what exactly, Peter?
Why?
So, what are you referring to?
I'm referring to the broader markets.
The broad stock markets. What's going to cause this
Absolutely.
crash?
What would cause it?
Yeah.
I mean, I could see something like bank failures, for example. A year ago, bank failures were an issue. Almost exactly a year ago, you had in the order of 3 or 4 banks in the U.S. You had Credit Suisse. That was a shotgun wedding. Was forced with UBS. You know, in the U.S., these 3 or 4 banks in the U.S. that went under, their assets got bought by the bigger banks. We're talking about $550 billion in assets. It took a matter of weeks for those failures to play out. Whereas if you look back to the financial crisis, it took 2008 and 2009 to reach a combined total assets, and it was 150 banks that failed to reach the same value that you reached last year with 4 banks. So, this is certainly leveraging up very quickly, and I think that if you think almost half of U.S. banks, commercial real estate is the largest loan category overall. Certainly, that's concentrated in the smaller banks, but some of the larger financial institutions have big commercial loan portfolios. So if you look at Wells Fargo, for example, I think it's something like 21%. So that's big. If we saw a big problem with Wells Fargo, I could certainly see that bleeding across the sector very quickly. That could trigger a huge sell-off in markets.
Well, yeah, certainly a bank failure would trigger a
And a
sell-off
Fitch
in
too.
markets. But
Yeah.
okay, so digging a little bit deeper, since you brought up banks, do you think banks are not well capitalized I mean, what fundamentally would be the it's like playing what's that game called? What am I thinking about? It's
Oh, shell like a shell game or
no, I'm
no?
okay. My mind's blanking this morning, but there's this game where you take a little piece of you build a tower with
Oh,
little
yes.
blocks,
I know what
and
you
then you
mean.
take that out and you take one thing out and it all collapses, right? You know what I'm
That's right.
talking about? I can't
I
remember
do.
the name. If you're watching
Me
this,
here.
please comment below. I'm having a brain fart this morning, but anyway, you take one piece out, the whole
Yes,
thing collapses, right? So what's that
exactly.
one thing? Is it the commercial real estate market popping? Is it the fact that banks can't sustain higher interest rates? Is it the fact that consumers can't sustain higher interest rates? I mean, last year it was because certain banks were not managing their risk duration, the duration on their
Right.
treasuries properly. So it was a risk management issue because interest rates went up, and then they couldn't cover bank runs. What's going to happen this year that would cause a bank failure?
So, I mean, that I think that the highest odds are with the commercial real estate loan portfolios. I think that's where we have to expect. Like I say, I think that last year it was a fire, and I think it's still smoldering. They've suppressed it. I think that could reignite certainly on renewed defaults. Rates staying high. The Fed, that we talked about this at the beginning. Odds are that Fed rate cuts will be pushed back. That is not convenient for for renewing commercial real estate loans, right? So mortgages on these properties are coming up for renewal, and if they have to be renewed at high rates, it's just going to put extra pressure on those companies. The odds of failure are high.
Okay, perfect. So let's go back to inflation again. CPI still harder than what the Fed would like it to be. What is causing the inflation rate to stay sticky at above 3%? The expectation from a lot of investors was that inflation would come down near 2% by this year. It doesn't look like it's happening yet. Why not?
I think that it has to do with inputs. We know that salaries have stayed high, and actually, they've workers have actually made some inroads in the last few months in terms of increases in their salaries. We know that inputs in terms of raw inputs like commodities, the producer price index has stayed resiliently high. It's actually quite surprising. Since it rallied, in the wake of COVID, it's actually stayed very high. That you can't get around that. Then you have energy, which is obviously a big input. Gasoline prices for transportation, for manufacturing services. Gasoline's a big one. Energy prices have stayed high. So gas prices were up 3.8% from January to February this year. That was just in the recent print today. So you have all of these things, all these inputs staying high. I just don't see how that's going to change, and that just kind of feeds into the sticky inflation levels.
You still think we're getting a recession?
I do. I
Okay.
do. Absolutely.
And what indicators are pointing towards that outcome?
Well, having overall, well, look, you've got lots of businesses are laying people off. You've got people who are struggling with paying rent, paying mortgages. You've got obviously the commercial real estate sector that we just talked about. So, you've got this going on in the background, and you've got, the one sort of exception I think is that we're seeing employment stay pretty resilient. I think that if we see that start to crack in a measurable way, that for me actually could be the trigger to get to sort of a clear recession.
Okay. What are the commodities signaling in terms of economic growth or a slowdown? Do you think there are certain commodities that may lead or have had a history of leading economic activity?
Sure. I mean, copper would be one of them. Copper has dialed back a little bit in the last couple of months. We're still, I think, around 380 a pound. That's obviously off of its highs, but I think that's sort of signaling a slowdown. I'd be kind of cautious on the base metals side, but I think that if you look at what's happening with oil prices, gasoline, in particular, obviously as a refined product, and that remaining high. That to me speaks to the fact that probably we're heading into something that looks like the 1970s in terms of stagflation. So you had a weak economy, but you had plenty of the underlying commodities remaining at high prices. So I think that gasoline is one of the bigger sort of indicators of that.
Don't you think that could also come from a supply restraint issue?
Absolutely. And so there's an interesting point, actually. If you look at what happened with inflation, it obviously took off in the wake of COVID, and we kept being told that it was transitory. Well, we know that in the past, when inflation is transitory, when it gets resolved when you have issues with if it's supply chain related. When the supply chain issues are resolved, these inputs, commodities, for example, tend to drop back. We haven't seen that happen. So I think that that's going to continue as well.
Peter, let's talk about silver now, a subject that you've researched a lot. You've written a best-selling book about silver. We'll get to some of the themes in the book in just a minute. But overall, Peter, right now investors are wondering, is silver overvalued, given that historically in the past couple of years it's been trading range bound? Actually, it's $24 an ounce right now. Just 2 years ago it was $20, and it's been hovering around the $20 and $25 range ever since 2022. So is it overvalued by, I guess, the last 2 year standards?
I would say absolutely not. I think that it's probably one of the rarest, fewest bargains you can find in the market today. Silver is still about 50% below its nominal all-time high, around $50, which it twice reached back in 1980 and then again in 2011. And if you look at the cost, the all-in cost to produce an ounce of silver, we're up in the at least low 20s. So the margins are quite thin. And it actually, in my view, would really be hard to find a better bargain right now. Some of the best noted investors, speculators as well, have been saying that it's the market's become stupidly cheap, in fact, in the silver space.
Can you elaborate on that? Why is it stupidly cheap?
Why? Just because it's so close to its production cost. Look at uranium. Uranium, doubled in the last 6 months or so. It traded at what, $20, $30 for a matter of months or years. And we know that all in production was at least $60, probably higher. So it traded at half its production cost for an extended period of time, and we're close to those levels. That's why I think the downside in silver is extremely limited at this point.
Here's what I would like to understand, Peter. Usually during a bull market for precious metals, at least, silver has historically outperformed gold. Now, I'm taking a look at the silver and gold prices since 2020, and I'll put a chart up on the screen for the audience to observe. Gold since 2020 is up 47.9, so 48%. Silver has done well, up 43%, so close. But why is silver slightly lagging gold in a huge bull market?
Right. So there are two aspects to that. One, we know that silver always lags gold, and I think that's more the investment demand side to silver. When gold moves because of investment demand, it gets the headlines. It's the king of assets, the king of metals, and so everyone pays attention to that. And when gold starts to rally significantly, let's assume for a moment gold went to 2,300, 2,500. Let's say it did that this year. That would generate a lot of excitement. People would be sort of flocking to gold. We'd start to see, the gold price appearing on CNBC on a daily basis. And then people would start paying attention to gold, look at it and say, obviously, there's a bit of FOMO involved, and they'd want to get a piece of the action. And especially if stocks are, let's say, suffering at the same time, they're looking for a market that's doing well. They're going to look at gold and they're going to say, wow, an ounce is setting me back 2,500 bucks. What else can I get? And silver, if silver was even 30 or $35 at that point in time, that's a massive bargain compared to gold. And we even know, with the gold silver ratio, that would still be a huge bargain. I think that you'd have considerable interest sort of bleeding into the silver market. And I think that's why you get silver catch up and then eventually outpace gold in bull markets, the investment demand side of it. Then we've got the whole sort of industrial demand side. And I don't know if you want to go there, but we've talked about multiple times about why is the silver price sort of trading in a consolidated range for the last 3 years if the outlook is so bullish, right? We're facing structural deficits in the silver market. 1.2 billion ounces of demand a year, 1 billion ounces of supply a year. So where is the silver coming from? And how come the price has been, is looking like it's capped? Well, I think through research, I've more or less found the answer to that.
The gold silver ratio is at a crazy 89 right now as we speak. Would you look at this ratio as a trading tool and say either short gold or long silver relative to gold? Does that, yeah.
Yeah, I would say when you see the ratio, to be sort of a bit more cautious and conservative about it, when you see the ratio fall back from above to below 80 and you see it consistently move down from 80 and downwards, normally what you're getting is you're getting silver catching up. Obviously, it's catching up to gold on a relative basis, but you're getting both metals doing well. So when the ratio falls, most of the time it's actually, and below 80, most of the time both metals are doing well, but silver is just doing better. It's actually rising faster than gold. So that's what I would look for the ratio to fall back below 80 and to keep falling from that level. That's when you want to get more aggressive on silver.
Here's my theory as to why silver may have lagged in the last 2 years, and please, correct me if you don't agree. I think perhaps gold is just signaling higher geopolitical tensions, and people buy gold for all sorts of reasons. Perhaps people are concerned about the markets having a correction. It's a safety play, whereby silver, being a monetary asset, does track gold, but it's also, like you pointed out, an industrial metal, and so that industrial component may be indicating some sort of economic slowdown, or it's predicting an economic slowdown. So silver investors are pulling back their inflows precisely because they don't think that silver will be used as much during the next recession, right? Do you think that makes sense?
Yeah, it does actually. And something I'd like to point out on gold is that, part of the research I do on a daily basis, um, it's clear that gold's been extremely resilient. And especially if you consider what's been happening with inflation, that inflation and real rates have stayed high. We've had this disconnect that has not happened before when real rates become weaker, that gold, or I should say, when real rates are high, that gold stays resilient the way it has been. So that's a disconnect that has not typically happened before, and I think that has been triggered by the U.S. weaponizing the dollar, making freezing Russian assets, and you have the rest of the world's central banks and large sovereign investors looking at that and saying, I need more exposure to gold. So the gold buying has been dramatic. The last 2 years have seen huge outsized buying by central banks. I think it was 1,082 tons bought by central banks in 2022, something like 1,037 tons bought in 2023. So this is 1,000 plus tons a year for 2 years straight, very much outsized compared to the prior years. And the gold market is 4,700 tons a year. So 1,000 out of 4,700 tons is just above 20%. So I did the math and I said, in the last 2 years, 1 out of every 5 ounces of gold was bought by a central bank. That is uncharted territory. We've not seen that before. That, I think, has made the gold price extremely resilient, despite the fact that we have positive real rates. And I think that's one of the reasons we've seen some of the equities lag. The interest has been from sovereign buyers, and it hasn't translated into the equities. Now, if you look at what's happened with silver, if we could switch gears for a moment, silver has been quite resilient. I put together a chart that I thought was really interesting, where I looked at what happened when the Fed started raising rates in early 2022, and what happened to the silver price. Well, interestingly enough, silver was already up. It was right around $23 or so, and then it started to back off right around when the Fed started to raise rates, but it stayed in a range. It's been sideways in the range since early 2022, between about, say, $23 and $20 and $25. Considering this was the most aggressive rate hiking cycle in something like 50 years, silver has actually been pretty resilient. And then if you look at why has the silver price not rallied more strongly in the last few years? Well, again, I've done some research and I've looked at if we have structural deficits in the silver market, and this is a question has just been coming back over and over for the last couple of years. People are saying, why has silver moved sideways? We have structural deficits, gold's running. What's capping the silver price? Well, you look at the inventories in the three major futures exchanges. So you have the COMEX, you have the LBMA, and you have the Shanghai. Now, there are two categories. You have overall silver inventories, and then you have registered silver. Now, the registered silver is the silver that's actually available for deliveries. So here's what I think is happening. Oh, there's one other thing you need to look at, and that is the silver ETFs. So if you look at those three exchanges, futures exchanges, and you look at the silver ETFs, they have all seen their inventories fall over the last 3 years, let's say, by about 30 to 40% overall. And some of those exchanges, if you look just at the registered silver, which is the silver that you could actually take in delivery, in some of those exchanges, it's down 70%. It's just unreal. So I think what's happening is you have large consumers, mostly industrial users of silver, have had a difficult time getting their hands on silver. And I can actually speak to an anecdotal reference I got from a large silver miner just a few weeks ago. In any case, I think these large silver consumers are buying long futures contracts. They're buying silver ETF units. And then they're waiting for the contract to mature and they're standing for delivery and they're taking delivery. This silver's coming out of those exchanges. It's going somewhere. So again, that's a lot of silver buying. We're talking about hundreds of millions of ounces, probably 500,000,000 ounces, probably more just in the last 3 years. So that there's going to be some limits to the amount of silver that you're going to find on these exchanges. We've seen that clearly shrunk. The silver ETF holdings have clearly shrunk. That has not happened in SLV, for example, on a sustained basis. SLV exists since 2006. We've not seen this kind of behavior in the silver holdings, silver inventories of SLV until the last 3 years. That has not happened. Even when you had price corrections in silver, you would not have sustained falls in the silver inventories of the SLV ETF. That is, again, uncharted territory. We've seen that start to happen in the last few years. So that's what I think is happening. These large consumers are buying long contracts. They're buying units in silver-backed ETFs, and then they're taking delivery of the silver.
Just on your note about how silver is in a structural deficit. So the Silver Institute is putting out research that would agree with your viewpoint. However, there's been debate as to whether or not net physical investment should even be counted in demand.
Right,
Because if you take that out, there's no more deficit, right?
right.
That's a big component in the demand. Everything else is industrial, but they're adding in net physical investment demand as part of the demand. And that really, skewed the balance towards the
Sure.
negative side. I mean, why should that be in there?
Well, this is a personal opinion, and that's what
Yeah.
we have to go on. But I
Right.
think that personally, I think it deserves to be there because I don't think that we're going to see that silver come back to the market unless silver is at much, much, much higher prices. So, in my point of view, from my point of view, for all intents and purposes, for quite some time, that silver's off the market at $23. I do not see, any kind of substantial portions of that physical silver buying, investment buying, coming back to market.
Yeah, but so if you're a retail investor and you want to buy physical silver, is there a scarcity right now? Like if you go to a dealer, there's a huge premium.
Absolutely. Absolutely. You're still looking at 30%, 40% premiums. Historically, it's 12 to 15%. And we've seen it, through COVID and when you could not get your hands on an ounce of silver, and through the silver squeeze of early 2021, we saw it go to 75%. We've got it saw in some places it went to 100% premiums. It was just crazy. But that's the new reality today.
So what do you think silver should be trading at, the fair value?
Fair value of silver, just physical silver, I'm going to say probably somewhere around high 20s, 26, $28 at least, if all-in costs are around 22. So I think that would be more realistic.
Okay, finally, Peter, let's talk about the second part of your book title, As the Dollar Dies. Crush inflation and profit as the dollar dies. Why is the dollar dying?
Um, you know, there's a great chart I have in some of my recent presentations. You look at global debt is 224 trillion dollars. I think it's something crazy. We reached a new record last year. The US is obviously, seeing its own debt spiraling. We're at $34 trillion is just US debt. This year alone, 30% of US debt is going to mature within a year, I should say, not this year, but within 12 months. And who's going to buy $9 trillion of US Treasury bonds? We know that foreign buyers are not interested in them anymore. That's been falling for about a decade now. We're at about 13-year lows in foreign holdings of US Treasuries. So that's going to be monetized. We're going to have no choice. The Fed's going to have to step in and buy that, and that's printing money. That's just going to, weaken the buying power of the dollar. By definition, inflation is more dollars sloshing around, and so the dollar is going to continue dying. It's a slow death. It's a death by 1,000 cuts, but it's well on its way.
Okay, and what would replace the dollar when when
You
when
know,
this death comes?
you don't have to have something specific replacing it. I think that, it's going to get weaker. I'm not saying it's going to be replaced tomorrow. That's not certainly my working narrative, for example. But I do think it's going to continue to weaken. I think that, trading is going to look, we're going to see these more and more of these formations of trading blocks. We've got lots of countries that are forging agreements between them so that they will accept each other's currencies to exchange goods, services. That's happening more and more. That's going to weaken the demand for the dollar. And I think ultimately we're going, I absolutely believe that we're in a long-term precious metals bull market. And I think de facto, gold and silver are going to become more and more currencies.
I understand the argument from the precious metals investor side, which is that if the dollar falls, your metals value will rise, maybe because it's denominated in dollars, and also because gold is seen as the anti-dollar asset, so to speak. But think about it: if the dollar does decline in value, every other currency in the world, by a pair trade, should go up as well, right? So what's special about precious metals in particular? It'll go up by default, but so will everything
Right.
else.
Oh, absolutely. Well, you know, don't think that other governments are not doing the same as the U.S. in terms of printing currencies. That some of them are actually a lot more efficient at doing that. I'll give you an example. Turkey has 65% annual inflation. Silver prices are up 7 times in the last 3 years. In Egypt, for example, Egypt, is very favorable towards gold. It's traditionally given to brides. It's traditionally given to newborns as a gift. They're now switching. Silver is becoming the new gold. The price of silver has doubled in Egypt in the last couple of years. So, yes, I mean, you're right. You've got this sort of offsetting thing, but if all of the currencies end up falling together, you certainly have, and we've seen it for thousands of years, precious metals have protected buying power. I think they're going to continue to do it in all of the currencies. And what you have as an investor slash speculator is the likeliness, and again, almost certain based on history, that precious metals are going to outpace the gains. When you get into these strong bull markets and then ultimately mania phases, these things become overpriced, and that's what people need to look for and ultimately eventually capture.
Can you give us a bear case for silver before we go?
Well, the bear case would only be, in my view, a short-term one, and that's probably, let's say, the risk that in the next, say, 6 to 9 months, roughly, when we go through some kind of a recession, that the market's going to say, you know what, this is really going to slow down the demand for silver because of its industrial component. And so it ends up taking somewhat of a hit. I think less so.
What's
Probably.
more important for the price, the investment component or the industrial component?
I think they're equal, and the reason I say that is because what offsets, in my view, the risk on the industrial side is that the risk of recession and the risk of some sort of a crisis, black swan, will fuel the buying on the investment side, and that would easily balance out any kind of slowdown on the industrial side.
Okay, very good. Where can we follow your work, Peter?
You can follow me at silverstockinvestor.com. I'm also on Twitter, Peter_Krauth. I'm on LinkedIn, and you can find my book it's on Amazon, The Great Silver Bull. That's the easiest.
We'll put all those links in the description down below, so make sure to check Peter out. Thank you very much for your time today, Peter. Appreciate
It
it.
has been my pleasure. Thank you so much.
We'll speak next time on silver and any market updates. So stay tuned and thank you for watching. Don't forget to subscribe and like this video.